An investor invests money into a company because they expect a return. That expected return is a cost to the company because the company must deliver it, and a return on investment for the investor. And since the investor has invested through equity, this becomes the company's cost of equity, which is denoted as KE. To measure this cost of equity, we use a model called capital asset pricing model, and it is widely known as CAPM. The cost of equity of a company is the risk-free rate plus market premium adjusted for sensitivity. Here, the risk-free rate is government bond, as risk of default is close to zero for stable governments. And the market premium depends on what you are valuing. So, for example, if you're valuing a company, then generally it is an index like S&P 500 or Nasdaq 100 or FTSE All Equity. And if you're valuing a property, then it is recommended to be a real estate investment trust. Now, adjusted for sensitivity, I'll explain a little later when we talk about the fundamental logic of CAPM. This is very interesting and logical if you can stay till end. And the formula is cost of equity is equal to risk-free rate plus market premium adjusted for sensitivity. Beta is used to measure sensitivity. Now let's move on to understanding the why behind the CAPM formula, the fundamental logic that makes this model work. Imagine a well-diversified portfolio. It has investments in IT, manufacturing, banking, defense, pharma, and fintech. In such a portfolio, if something bad happens in one sector, something good might happen in another. These ups and downs cancel out each other. This type of sector-specific risk is called unsystematic risk. For example, new license requirements for pharma, FX risk affecting manufacturing, regulatory changes in defense, or funding pressure in fintech. All these risks are specific to sectors or companies, and in a diversified portfolio, they get averaged out. But above these sector-specific risks, there are macroeconomic forces that affect every sector in the portfolio. These are called systematic risks. For example, inflation, interest rate changes, COVID type shocks, geopolitical tensions, recession, liquidity cycles. These risks hit the entire market, so they hit the entire portfolio. And because they cannot be diversified away, CAPM focuses on these systematic risks. This is where beta comes in. Beta is used to measure how sensitive your investment is to these market-wide risks. Now, let's revisit the formula again. The cost of equity of a company is risk-free rate plus market premium adjusted for sensitivity. Sensitivity means how sensitive your investment is to market-wide risk known as systematic risks, which cannot be averaged out even in a well-diversified portfolio. This sensitivity is measured by beta. Based on these risks, an investor expects a compensating premium. And hence, the formula is cost of equity is equal to RF plus beta times market rate less the risk-free rate, which is market premium. Now, a very important point I want to make. Many people get confused between volatility and sensitivity. They think both are the same, but the fact is they are not. Volatility means risk. Too much movement is risky. To measure volatility, we use standard deviation. Standard deviation measures the risk of an instrument by itself. So volatility is an absolute measure. But sensitivity measures how much does an investment move in comparison to something else. This comparison is done by using beta. The general thumb rule is if beta is equal to 1 means it's directly proportional. If it's less than 1, it's less proportional, and if it's more than 1, then it's more proportional. So sensitivity is a relative measure. Like everything else, CAPM has some criticism. CAPM uses one factor, the market. This means it bundles all systematic risk together and assumes them all move together. But in reality, all systematic risk never move together. Therefore, a more realistic approach is a multi-beta model. In a multi-beta model, each systematic risk has its own beta and its own risk premium. So, multi-beta model captures multiple systematic risks and their non-linear movements, something CAPM misses. And the difference between the formula is where B1 is market beta, which is the same as CAPM's beta, means it bundles all the systematic risk together to constitute a market. B2 is the size beta. Does your investment behave like a small cap or a large cap? And B3 is the value beta. Does your investment move like value stock or a growth stock? I hope you've liked it, and I genuinely wish it is useful to you. If you have any questions, please feel free to put them in comments. I'll be very happy to help. And if you are a student or a finance professional, then I have written an ebook covering all the real interview questions asked in FP&A, finance business partner, senior management accountant, and any other finance roles. These are real questions from real interviews I've personally attended, along with model answer frameworks you can use straight away. If you want to level up your interview game, then the link to buy the ebook is in the description.